Hi, thank you for watching Digging to China. I'm Dong Sheng. If you have not done so already, please subscribe to my channel. Thank you very much. On October 18th, the National Bureau of Statistics in China unveiled the GDP growth figures for the third quarter of this year. In Q3, China's GDP witnessed a 4.9% year-on-year increase. During a press conference, Sheng Laiyun, the Deputy Director of the National Bureau of Statistics, stated that the GDP growth for the initial 3 quarters of the year amounted to 5.2%, laying a solid foundation for reaching the annual target of approximately 5%. Sheng Laiyun also noted that to achieve the yearly target, the growth rate in the fourth quarter need only exceeding 4.4%, a threshold that he expressed great confidence in meeting. This sentiment stems from President Xi Jinping's plans to bolster GDP through extensive infrastructure projects in the upcoming quarter. However, can this number be genuinely trusted? It seems the capital market is rather skeptical. Judging by the performance of China's A shares, there is a noticeable lack of faith. On October 18th, Shanghai Composite Index fell by 0.8%, declining to a mere 3,058 points and subsequently slipping below the significant 3,000-point threshold. Why is there such doubt surrounding the economic data from the National Bureau of Statistics? What methods has the National Bureau of Statistics employed to potentially mislead us? To begin, it's essential to comprehend the respective contributions of the 3 primary drivers in boosting this year's GDP. They are investment, consumption, and exports. Based on data disclosed by the National Bureau of Statistics, the GDP for the initial 3 quarters of the current year reached 91.3 trillion yuan, while the baseline figure for 2022 stood at 87.03 trillion yuan. Consequently, the GDP's incremental growth for this year amounts to 4.27 trillion yuan. Moving on, let's analyze how much incremental value each of the 3 key drivers, investment, consumption, and exports, contributed to this year's GDP growth. According to the NBS's press conference, consumption made the largest contribution at 83.2%, resulting in an additional 3.8 trillion yuan. Investment followed with a contribution rate of 29.8%, yielding a GDP increase of 1.27 trillion yuan. However, exports had a negative contribution rate of 13%, causing GDP to decrease by approximately 600 billion yuan. Next, let's delve into the data released by the NBS regarding the total retail sales of consumer goods for the first 3 quarters. This figure amounted to 34.21 trillion yuan, marking a 6.8% year-on-year increase. Consequently, the incremental value generated by personal consumption during this period stood at 2.18 trillion yuan. It's worth mentioning that the consumption component in GDP encompasses not only the total retail sales of consumer goods, as reported by the NBS, but also government consumption. The total retail sales of consumer goods typically refer to personal consumption, which covers the day-to-day expenses of the general public. As the Chinese government does not publish data on government consumption, these calculations need to be made manually. Using the data we've just reviewed, we can calculate that government consumption expenditure increased by approximately 1.6 trillion yuan in the first 3 quarters of this year. Applying the same method to determining the incremental value of government consumption expenditure for the previous year, we find it to be around 1.3 trillion yuan. In contrast, last year, personal consumption saw only modest growth with an increment of a mere 224.8 billion yuan due to the pandemic's impact. Consequently, this year has seen an increment of approximately 2 trillion yuan in personal consumption. However, a comparison with 2021 data reveals a significant difference. In 2021, personal consumption witnessed a substantial increase of 4.4 trillion yuan, contributing to a total consumption increment of 6.48 trillion yuan in GDP. This implies that government consumption only rose by 2 trillion yuan in 2021, which was less than half of the increment in personal consumption. Now, in the current year, with the lower base from the previous year, personal consumption has only seen a 2 trillion yuan increase. In contrast, government consumption has experienced a substantial increment of 1.6 trillion yuan, nearly becoming the primary driving force behind consumption in China. The data presented here makes it evident that this year's so-called consumption recovery is primarily powered by the government sector rather than by households. This is why when the MBS attempts to mislead by highlighting strong domestic demand and excellent consumer data for this year while only revealing personal consumption figures, it creates a misleading impression that the GDP is being driven primarily by the consumption efforts of the general public. To reiterate, considering the meager consumer spending increase of less than 2.2 trillion yuan contributed by ordinary citizens last year due to the exceptionally low consumption base, their contribution to GDP growth was merely around 2.5%. On the other hand, government consumption substantially boosted GDP growth by nearly 2%. To accentuate this misleading narrative, the National Bureau of Statistics must persist with two more fabrications. The first deception involves the claim of a rapid surge in disposable income for citizens. According to data provided by the MBS, the per capita disposable income for people in China in the first 3 quarters of this year reportedly soared to 29,398 yuan, showing a nominal growth rate of 6.3% compared to the same period last year. When adjusted for price factors, this income still exhibited significant real growth at 5.9%, outpacing the GDP expansion rate. Notably, the per capita wage income across the nation even experienced a remarkable 6.8% increase. Even by considering the median value, the per capita disposable income for Chinese citizens stood at around 24,528 yuan with a growth rate of 5.4%. According to this dataset released by the MBS, it indeed seems to support the notion that a higher income results in increased consumption. It also subtly suggests that a substantial portion of the liquidity introduced by the central bank has made its way into the hands of the general populace. Nonetheless, this data has been distorted to an extent that even the most ardent supporters are struggling to defend it. The most glaring evidence of this manipulation can be seen in the reduction of personal income tax. According to data from the Ministry of Finance, which is only available up to August, there was a 0.1% year-on-year decrease in personal income tax during the first 8 months. This decrease in personal income tax contradicts the reported high-speed growth in per capita wage income and the per capita disposable income. The second falsehood from the Statistics Bureau revolves around the unemployment rate. In the first 3 quarters, the National Urban Survey unemployment rate averaged 5.3%. Furthermore, in September, the unemployment rate even decreased by 0.2 percentage point, painting a positive picture of the employment situation. If the employment situation is genuinely strong, one might wonder why the Statistics Bureau refrained from releasing youth unemployment data in September to boost public confidence. The unemployment rate data based on surveys in China is intrinsically unreliable, serving primarily as a tool for the Statistics Bureau to pacify the public. This year, the Statistics Bureau conspicuously avoided releasing youth unemployment data, solidifying the belief that China's unemployment rate is inflated. Nevertheless, to sustain one falsehood, the Statistics Bureau continues to perpetuate numerous others, even if their credibility has waned. After discussing consumption, let's delve into the investment aspect. Judging by the scale of monetary easing carried out by the central bank this year, the M2 balance at the end of September amounted to 289.67 trillion yuan, compared to 266.43 trillion yuan at the end of the previous year. Therefore, M2 has expanded by over 23 trillion yuan this year. However, when we assess incremental GDP, it's just under 4.3 trillion yuan. Contrasting this with the data from 2021, M2 increased by about 20 trillion yuan, yet GDP witnessed an increment of 13 trillion yuan. This implies that the efficiency of monetary easing was 65%. Meaning that investing 1 yuan resulted in a GDP growth of 65 cents. However, fast forward 2 years during the so-called economic recovery phase advocated by the Communist Party, a 23 trillion yuan increase in M2 only generated a 4.3 trillion yuan growth in GDP. Doesn't the rapid reduction in the marginal effect of monetary easing seem somewhat astonishing to you? Investment remains a perplexing matter within the framework of the Communist Party. As the figures indicate, in 2022, total fixed asset investment for the initial 3 quarters amounted to 42.14 trillion yuan. However, in 2023, for the corresponding period, the reported total stands at 37.5 trillion yuan, while being described as a 3.1% increase compared to the previous year. This discrepancy actually signifies a decrease, doesn't it? The primary explanation is that the MBS adjusted the base figures from the previous year. The Bureau's report acknowledges that there were certain segments in the investment data from the previous year which involved duplicate calculations or statistic errors, necessitating correction. This correction, however, was remarkably substantial at 13.7%. In essence, it applies that a staggering 13.7% of the investment data released by the Statistics Bureau last year was considered invalid. But is this type of invalid investment unique to last year? Most likely not. It is likely a recurring phenomenon annually. Hence, it is quite probable that at this same point next year, the investment data for this year will also undergo downward revisions by the Statistics Bureau. Consequently, the 3.1% growth rate lacks substantial significance, and a more relevant approach is to assess it with unadjusted figures, untouched by revision. So we can deduce that this year's growth rate in fixed asset investment should actually be negative, approximately negative 11%, to align with reality. Even if we entertain the notion that investment growth rate is indeed 3.1%, yielding around 1.27 trillion yuan in GDP increment, it doesn't stand up to scrutiny when contrasted with the M2 increment. The efficiency of investment appears markedly deficient, wouldn't you say? Regardless of one's stance, whether you are a critic or a supporter, there appears to be a common understanding within the realm of China's economy. This year, the country's economic growth is predominantly steered by government investment, meaning most of the liquidity is channeled to the government with limited direct impact on the general populace. So, what does the government do with this infusion of funds? They employ it for consumption, investment, and mark up GDP. However, this year, despite a substantial increase of 23 trillion yuan in M2 money supply, the GDP has only witnessed a growth of 4.3 trillion yuan, and there are indications that this increase may not be as substantial as it appears, rendering it somewhat unconvincing. I'd like to pose a question to all of you. Is it really the best approach to rely so heavily on the government to drive our economy? A clear trend is emerging, even in the realm of consumption, that suggests Chinese citizens are gradually losing their economic influence. Instead, government consumption is taking the lead and becoming the primary driver of consumption growth. But where is the government's spending primarily directed? Given China's current situation, it's rather disheartening to say that it's unlikely to be directed towards social welfare or public services. Instead, a significant portion probably goes into military expenditures. This type of spending doesn't stimulate genuine domestic demand. It's only when everyday people buy food, clothing, and engage in recreational spending that we witness consumption that truly fuels economic growth. Moreover, government investment tend to revolve around a slew of infrastructure projects aimed at inflating GDP figures, often without delivering profitable return. Examining fiscal data from various provinces reveals a bleak picture when it comes to the return on special bonds. In some provinces, achieving even 1% return rate is a challenge, highlighting the disparities in projects and the significant resource wastage. It can be inferred that next year's economic growth will probably mirror this year's situation, injecting more liquidity with lower investment efficiency to barely attain an acceptable GDP growth rate. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I will see you again shortly. Until then, be well.